Have you ever looked at legendary investors like Warren Buffett or Charlie Munger and just wondered, what is their secret? How do they do it year after year? Well, I can tell you it's not a crystal ball. It's something much more powerful. It's a specific way of thinking. Today, we're going to pry open that toolbox and look at the mental frameworks that the world's best investors use every single day.
And right away, you can see the huge difference. It's like two different worlds. On one side, you have the average investor. They get swept up in the market noise, making decisions based on fear and greed. But on the other side, you have the elite investor, and they operate on a completely different level. They use a structured, rational system to make their calls, which helps them filter out all that emotional chaos. So, what is this secret weapon they're using?
It's called a mental model, and really it's just what it sounds like. Think of it as a tool for your brain, a framework that helps you make sense of this incredibly complex world. So instead of just reacting to what's happening, you're actually analyzing it. This is the key that closes that gap between average results and elite performance.
And you gotta hear this wisdom from the master himself, Charlie Munger. His point here is absolutely crucial. You can't just have one favorite tool in your toolbox. The world is way too complicated for that. You need a whole collection of different models, because that's the only way you can see reality for what it is, instead of trying to twist and torture it to fit your own narrow view.
So, let's start building that toolkit, shall we? We're going to kick things off with 3 foundational models. These are the ones that really form the bedrock of a professional investing process. First up is the circle of competence. Honestly, this one is all about intellectual honesty. It's about knowing what you know, sure, but way more importantly, it's about knowing what you don't know. The real discipline here is having the guts to stay firmly inside that circle and to admit where your boundaries are.
So how do you apply this to investing? It sounds simple, but it's really not easy. It means you only invest in businesses and industries that you can genuinely understand and explain to someone else. Some of the biggest mistakes in investing come from wandering into complex areas where you really have no business being.
I mean, think about Warren Buffett during the dot-com bubble in the late 90s. Everyone thought he was crazy for avoiding all those hot tech stocks. But you know what? They were outside his circle of competence, so he stuck to what he knew, simple, understandable businesses like Coca-Cola. And guess what? He quietly generated fantastic long-term returns while everyone else was getting burned.
All right, our second tool is a real game changer. It's a powerful one called inversion. So instead of just asking, how can this investment succeed, you flip the whole problem on its head. You start by asking, what would absolutely guarantee failure here? And then you work like crazy to avoid those things.
In investing, this basically means you become an expert in what could go wrong. Before you even think about putting $1 into a stock, you actively search for all the reasons it could be a complete disaster. You make a list of all the red flags, all the worst-case scenarios, everything that could possibly destroy the business.
And just think about how powerful this is for avoiding catastrophe. Take the insane collapse of Wirecard. An investor using inversion would have asked a simple question. What if the numbers are totally fake? Just that one simple inverted question could have saved them from losing everything. It's about avoiding stupidity, not just trying to be brilliant.
Okay, this third foundational model, this one requires a real mental shift. See, the future isn't just one single certain thing. It's a whole range of possibilities. Probabilistic reasoning forces you to stop thinking in black and white terms like win or lose, and instead start thinking in shades of gray, assigning odds to all the different scenarios.
So in practice, what does this look like? It means you stop looking for just one price target. Instead, you map out a few possible futures for a company. You might have a great case scenario, a base case, and a bad case. Then, you assign a probability to each of those outcomes to figure out what your expected return really is. Check out this analysis for Tesla back in 2019. I mean, its future was incredibly uncertain. A smart investor wouldn't just bet everything on it becoming a revolutionary success. No, they'd weigh the odds. Maybe a 30% chance of bankruptcy, a 40% chance of modest success, and a 30% chance of a home run. This kind of disciplined approach gives you a much more rational way to make a decision, even when things feel totally chaotic.
So, those 3 are the foundation. They're your starting point. But to really handle the market's complexity, the best investors are always expanding their toolkit. Let's touch on some other essential models that you can add to your arsenal.
So you've got amazing concepts like margin of safety, which is really just about buying $1 for 50 cents. You've got systems thinking, which helps you see the domino effect of any decision. And then there are economic moats, which is all about spotting a company's real, durable, competitive advantage. Each one of these is like another lens you can use to see the world more clearly, and the real magic happens when you start to use them all together.
Okay, so we have the tools, that's great, but how do you actually use them in a real-world situation? You know, a great craftsman doesn't just have tools, they have a process. So let's look at how you can integrate all these models into a professional framework you can use again and again.
This process right here really puts it all together. You start with step 1, do I actually understand this? That's your circle of competence check. Then you immediately jump to step 2 and invert. What could go totally wrong here? Next, you assess the probabilities. You calculate your margin of safety, you analyze the bigger system, and then finally, you do a reality check against what's happened in the past. Following these steps, in this order, creates this incredibly powerful systematic defense against your own worst enemy, which is usually emotional bias.
Now, here's the thing. Learning about these models is one thing, but actually mastering them, that's a whole different ballgame. This isn't some quick fix, it's a lifelong journey of practice and getting better. And that journey to mastery follows a pretty clear path. It starts with just focused study, reading, learning, taking notes. From there, you move into a dedicated practice phase where you consciously apply, say, 3 to 5 of these models to every single decision you make. And then over time, with consistent effort, these models stop being a checklist. They start becoming an automatic, intuitive part of how you think. And I love this quote because it connects two incredibly powerful ideas. Just like the magic of compounding works best when you don't mess with it, your thinking works best when you make it multidimensional. Using this whole latticework of models is your absolute best defense against a complex and, let's be honest, often unpredictable reality.
So there you have it. We've just unpacked the playbook of the masters. The tools are all here, from the discipline of staying in your circle to the wisdom of thinking in probabilities. So now, the only question that really matters is for you. Which one of these models will you put into practice first?